Imagine standing at the edge of a roaring financial market, holding your entire life savings in a single fragile basket. According to industry data, despite decades of warnings, a staggering number of self-directed investors hold portfolios concentrated in just 3 to 5 individual stocks, driven by the powerful illusion of control. Why do so many intelligent people ignore the most fundamental rule of investing? The answer lies deep within our psychology, the relentless pressure of market hype and the deeply ingrained human desire to find a shortcut to lasting wealth. To understand this paradox, we must first define exactly what we are talking about. True diversification is the practice of spreading your investments around so that your exposure to any one type of asset is limited, fundamentally designed to reduce the volatility of your portfolio over time. It is the financial equivalent of building a ship with multiple watertight compartments so that a single leak does not sink the entire vessel. Yet executing this seemingly simple concept is surprisingly difficult in the real world. The difficulty stems largely from the field of behavioral finance, which studies the effects of psychology on investors and financial markets. Human beings are hardwired to follow the herd, a survival mechanism that served us well in the prehistoric wilderness but often leads to absolute financial ruin. When we see our neighbors getting rich quickly on a hot tip, our rational understanding of risk management is easily overpowered by the fear of missing out and a dangerous psychological phenomenon known as recency bias. We can see this herd mentality vividly in the late 1990s during the dot-com bubble. Investors completely abandoned traditional valuation metrics, pouring their capital entirely into internet companies with zero earnings, driven solely by explosive stock charts and media frenzy. The allure of overnight wealth was so intoxicating that even seasoned professionals concentrated their holdings almost exclusively in the technology sector, convinced that a new economic paradigm had arrived and that the old rules of investing no longer applied. When reality finally set in, the consequences for those highly concentrated portfolios were devastating. The technology-heavy indices lost over 75% of their value in a matter of months, wiping out trillions of dollars in wealth and completely devastating the retirement dreams of those who ignored the principles of broad market exposure. The profound pain of that era serves as a stark, historical reminder of exactly what happens when unchecked greed overrides prudent risk management. Preventing such catastrophes requires a disciplined approach to asset allocation, which is the strategic division of an investment portfolio among different asset categories, such as stocks, bonds, and cash equivalents. The goal is to balance risk and reward by apportioning your assets according to your specific financial goals, your personal risk tolerance, and your long-term investment horizon. It is the architectural blueprint of a resilient financial house, ensuring that no single structural failure can bring down the roof. However, maintaining that blueprint is a severe emotional trial for everyday investors. During a roaring bull market, your safe bonds or defensive dividend stocks will inevitably drag down your overall returns compared to the high-flying tech darlings dominating the headlines. True asset allocation means you will always own something in your portfolio that you are deeply unhappy with in the short term, which feels entirely counterintuitive when your primary goal is to maximize your wealth. As Nobel laureate Daniel Kahneman observed, human beings experience the psychological pain of a financial loss roughly twice as intensely as the joy of an equivalent financial gain. This psychological asymmetry, known as loss aversion, makes it incredibly hard to willingly sell a portion of our winning investments to buy more of our temporarily losing ones. Yet this exact counter-emotional behavior is the critical mechanism that maintains a balanced, resilient portfolio over decades. This emotional trap was perfectly illustrated again during the lead-up to the 2008 housing crisis. For years, real estate was culturally perceived as a completely safe, continuously appreciating asset class that offered a guaranteed path to the middle-class dream. Millions of people concentrated their entire net worth heavily into property, taking on immense, unsustainable leverage, firmly believing the widespread myth that national housing prices could never simultaneously decline across the country. The subsequent collapse violently shattered that illusion, proving that even seemingly tangible, universally beloved assets carry massive systemic risks. The devastation of the 2008 housing crisis rippled relentlessly through the global economy, destroying the net worth of households whose financial foundations were built entirely on a single, over-leveraged pillar. Those early lessons in broad market exposure and the dangers of extreme concentration were painfully relearned by an entirely new generation of investors. Another critical threat to concentrated wealth is inflation, defined as the rate at which the general level of prices for goods and services is rising, thereby steadily eroding your purchasing power over time. If your portfolio is heavily skewed toward cash or low-yielding fixed income, you might feel entirely safe from sudden market crashes, but you are slowly bleeding real value to the rising invisible cost of living. Different asset classes react very differently to inflationary pressures in the broader economy. While traditional bonds may suffer significantly as interest rates rise, certain equities, real estate investment trusts, or raw commodities might offer a necessary hedge against those rising prices. This dynamic, constantly shifting interplay is exactly why holding a varied mix of assets is absolutely crucial for protecting your purchasing power across highly unpredictable economic cycles. Beyond mixing asset types, geographic exposure is a vital layer of portfolio protection that many domestic investors completely overlook. It is incredibly common for individuals to exhibit severe home country bias, investing almost exclusively in the domestic companies they know, trust, and interact with daily. While psychologically comfortable and familiar, this leaves your entire financial future tied exclusively to the economic policies, regulatory environments, and fortunes of a single nation. By expanding your perspective globally, you actively insulate yourself against localized recessions, regional political instability, or sudden currency devaluations. If the domestic market stagnates for a decade, as has happened historically in various advanced economies, a globally spread portfolio can seamlessly capture growth in emerging markets or rapidly recovering regions, smoothing out your overall returns and reducing regional vulnerability. The ultimate reward for maintaining this strict discipline is the optimized engine of compound interest, which is the addition of interest to the principal sum of a deposit or investment, essentially earning interest on your previously earned interest. Over decades, this mathematical phenomenon creates truly exponential wealth growth, but it requires uninterrupted time, patience, and preserved capital to work its full magic. The silent power of compounding is severely crippled by massive portfolio drawdowns. If a highly concentrated portfolio loses 50% of its total value, it requires a monumental 100% gain just to get back to the initial starting line. By limiting those catastrophic drops through prudent, widespread risk distribution, you ensure that your capital continues compounding steadily rather than spending years merely recovering from entirely avoidable mathematical mistakes. To maintain this protective balance, investors must periodically engage in the mechanical process of rebalancing. This means actively selling off the specific assets that have performed brilliantly and using those exact profits to buy the assets that have recently underperformed the broader market. It is a rigid, rule-based process that forces you to buy low and sell high, yet it feels agonizingly wrong to punish your current winners and reward your current losers. One of the most effective tools for achieving immediate, broad-based exposure without the daily stress of individual stock selection is the strategic use of index funds. These are mutual funds or exchange-traded funds specifically designed to track the performance of a specific market benchmark, like the S&P 500, rather than relying on an active manager. They offer an elegant, highly efficient, low-cost solution to the overwhelming complexity of building a varied portfolio completely from scratch. By purchasing a single index fund, an investor instantly acquires fractional ownership in hundreds or even thousands of individual companies across multiple economic sectors. This collective, diversified structure automatically neutralizes the specific risk of any single company going bankrupt, suffering a catastrophic leadership scandal, or losing its competitive edge. It fundamentally democratizes access to sophisticated risk management, allowing everyday people to invest with the structural resilience of major financial institutions. What happens when we fully embrace this broader systemic approach to investing? We willingly trade the unpredictable adrenaline rush of chasing the next hot stock for the profound, lasting peace of mind that comes from true structural stability. You are no longer trying to desperately find the needle in the haystack, you are simply buying the entire haystack, efficiently capturing the long-term upward trajectory of human innovation and global economic growth. It is vital to acknowledge a persistent, dangerous myth. Spreading your investments does not guarantee you will never lose money. Market volatility will still cause your account balance to fluctuate wildly at times, and during severe global panics, most asset classes will temporarily decline together in tandem. The primary goal is not absolute invincibility, but rather long-term survivability, ensuring that a temporary market panic does not become a permanent personal catastrophe. As we look toward an increasingly interconnected and rapidly shifting global economy, the fundamental need for this protective strategy will only intensify. Massive technological disruptions in artificial intelligence, complex geopolitical realignments, and shifting global monetary policies will create highly unpredictable winners and losers. Relying on yesterday's concentrated success stories is a dangerous gamble in a modern world where entire legacy industries can be rendered obsolete practically overnight. Financial professionals universally agree that the only true free lunch in investing is the mathematical reduction of risk through proper asset distribution. It requires immense personal humility to admit that we cannot reliably predict the future, and that humility is expressed financially by refusing to bet everything on a single speculative outcome. It is a profound psychological shift from trying to outsmart the complex market to intelligently and safely participating in it. Building this kind of lasting financial resilience starts with a brutally honest, objective audit of your current investment holdings. Are you heavily concentrated in the stock of your current employer, tying both your income and your savings to one entity? Is your wealth entirely tied up in a single local real estate market that could face regional downturns? Recognizing these specific vulnerabilities is the very first step toward restructuring your financial life for extreme durability rather than just short-term performance. Navigating the immense complexities of modern wealth building demands a strategy that protects you from your own psychological biases just as much as it protects you from the turbulent markets. By embracing the challenging but absolutely essential discipline of spreading your risk, you fortify your financial foundation against the terrifying unknown. Ultimately, true prosperity is not about making one lucky concentrated guess, but about constructing a resilient portfolio that can weather any economic storm and patiently compound your wealth for generations to come.